Hi, everyone. Thanks for joining us on this COVID-19 webinar series. I know we're a little off with our regular time. We had some other conflicts this week. So we're resuming this presentation. I'm very excited today for our presentation because we got our expert Naomi over here who has a background on both advising corporations on their 401k plan as well as individuals picking their best strategy for retirement funds. And Naomi is licensed in, I kind of listed in my bio, like for Naomi, but she's licensed in many, many different licenses related with, investments, related with retirement investment, retirement funds. So she's really an expert on this. And the reason why I'm really excited about having her here is oftentimes, we hear a lot about these, retirement fund presentation, etc., from people who has their policy setters and etc. They always try to sell you a service or products that they have, but Naomi is kind of unique in this aspect. She's being on both sides of coins, on the employer side and the employee side, and she's an investor who has solo 401k account, who has self-directed IRA. So she's very much well versed in this subject. So that's why I'm really excited about her coming in, not only telling us about what we can do with the CARES Act to get some more dollars from our retirement fund, but also to kind of hear about pitfalls if we do decided to do that, and also segue into how do we deploy and redeploy between different retirement vehicles. So I'm going to have a lot of questions for her because this is a session I'm actually really excited about. Thank you, Naomi. Do you want to kind of give us a rundown on your background?
Yep. Hi, everyone. Thank you so much for having me today. I think the reason I'm so interested in this is because it's a confluence of two things that I'm really interested in. I've been working with retirement plan and investments for the entirety of my career, which is close to 30 years. And I've been a real estate investor for about 5 years. And I have different paths in my retirement investing strategies. So not only do I have a business, be a doer too, that invests directly in rental properties, I also have a self-directed IRA that invests in syndications and real estate. I also have a checkbook IRA where I've purchased homes, fixed them up, and then sold the houses. I'm a note holder. So really a lot of different things. My largest unit is a 4-unit, and beyond that, I invest through syndications. I'm in 4 different syndications in the Southwest. So bringing those two things together is kind of an interesting thing to me. I was actually doing a recap for a mortgage broker, and I thought, maybe there are some other people that are interested in this. So I sent the information to Elisa. And so we thought that it might be a nice thing to kind of talk about how the CARES Act works, even from a high level perspective, even maybe for your own personal situation, but also in terms of how it could potentially tie over into your real estate investing. So that will be the lens in which I am giving this information to you. So with that, I think I'm going to jump right into it. First and foremost.
And just kind of a few housekeeping things. So you all know, for a few of you guys already attend these series, put your question on the Q&A, and we would love to have these as interaction session, which is why the benefit of you guys making it to hear live versus listening to recording, because we can answer these Q&A questions pretty deep. And I know I have my list of questions for Naomi later on. So please feel free asking all the questions that you have there. Thank you. Go ahead, Naomi.
Thank you. So a couple of things, of course, like any session. First and foremost, I am not a CPA. That's just at the end of story. So I can't go super deep in terms of the tax consequences. The next thing is that what I'm providing you really is of an educational nature. I really just want you to understand what's out there and how, in fact, it might apply to you. Ultimately, if you are someone who's working with a tax advisor and you're considering any of the things that I'm going to be talking about today, I would really strongly advise that you have a conversation so that you can really kind of see what the impacts might be. Finally, I am also a W-2 employee, and I want to make sure everybody is clear that I'm not representing the company that I work for. And one little side note is that you may have questions for me today that I cannot answer. There's a lot of fluidity going on in terms of guidance needed with some of these new provisions, and we just don't have the answer. So I will do the very best that I can. If I think I can get you the answer, you'll see that I have provided my email address later in the show. If I know that I just cannot answer it, I'm going to tell you that right up front and try to direct you towards a source who can answer those questions for you. So what am I going to be talking about today? I am going to be talking about the fact that there is a qualification to do any of the things that I'm talking about today. And then I'm going to talk specifically about distributions out of your retirement plan. I'm going to talk about loans from your retirement plan. And then something that's not in the CARES Act, but in the SECURE Act that just passed in December of 2019 with regards to required minimum distributions. So what is a qualified individual insofar as it relates to the CARES Act? First and foremost, this is any person, you, a spouse, a dependent who has tested positive. So that includes that. This can also be a person who's been impacted financially. So I think about my boyfriend, Herbert. He was laid off from Boeing. So he would qualify, if you will. The fact that we live together in a household would potentially mean that I qualify. I was sharing with Elisa earlier, some other reasons I might qualify are because now I have dependents living with me again because of COVID. They've been traveling, they had to come back home, they can't get jobs, so I am supporting them.
So very interesting question there, Naomi. So I'm going to interject with some questions over here. Tell me if I'm getting too annoying there. But basically, tell us a little bit of how you prove that. Maybe I'm kind of jumping the gun over here. How do you prove kind of like the income? For example, your kids are staying at home, right? Like the not being furloughed is very easy to kind of qualify for that because, hey, like there's the paperwork that they give it to you when they're sent you the pink slip or whatever. But how do you actually qualify to say, hey, now I have more dependent, my cost goes up?
Well, I think I could probably show that in my bills first of all, but I suppose I could get an affidavit from them. I could show that there was canceled trips. I could show some kind of a paper trail that kind of supports what I'm saying. The interesting thing, and I do talk about it later, if this is something you're going to pursue, it's really up to the plan administrator what they're going to make you provide. In some cases, it's very easy to provide, like, hey, here's my test results. Here is my furlough papers. I don't think that and this is just an opinion, I don't think that the proofing process in terms of documentation is going to be super stringent unless, for example, your employer just really requires that. The burden of proof is ultimately if the IRS came back on you, it would be up to you to prove it. So I would, as a tickle in the back of your mind, at least be thinking, hey, if I ever did get audited, what do I have that I can put into a file to cover my back end? So I can show that, yeah, there were some things going on financially or with my business that really allows me to be able to tap into these dollars.
Yeah, that's awesome. Because I know you want to get into some other different type of vehicle other than just traditional 401k later. So I'll let you cover that. But this actually was a good idea. I haven't thought about that. Like increase of expenses is also living expenses is also potentially a hardship.
It is a hardship if you're not used to paying for it. It means that your budgetary costs have increased, and that's a burden on the household. Now, I did put a link in here for more detailed information. And of course, if you work with an accountant or a CPA professional of some sort, they might be able to help you navigate that. But when you, I think she's going to be sending this out. So the link is right in the PowerPoint if you want to get to that. Any other questions before I move on this particular page? So here we go. Here are the plans that qualify. Not very many of you have probably heard of a 401A plan. It's a money purchase plan. There's not a lot of employers that have these anymore. But if in fact you work for an employer that does a 401A money purchase plan, this does qualify. 401ks, that includes solo 401ks, do qualify. Sidebar, it is important for you to know that your plan must allow for loans, and not all 401k plans even allow for loans. So this is something that your administrator is going to need to answer for you. If you know that your plan allows for loans, then this may be something that you can tap into. 403B plans, now with loans, some, not very many, have loans, but the distributions that I'll be talking about do apply to this. And the other one is a governmental 457 plan. So employees who work for cities, counties, state plans, each one has their own alphabet soup. Let's just put it that way. The distribution option I'll be talking about would also apply. And finally, IRAs are also covered.
And this includes the self-directed IRA. Yep.
Yep, that's what that does include any IRAs.
Cool.
So there's really two primary things I want to talk about with regards to your retirement plan. One of those is a distribution, a penalty-free distribution. So as a reminder, in a 401k plan, in an IRA, for example, you must be 59 and a half to withdraw money from your plan without a penalty. Whatever you draw from your 401k plan will be added to whatever income, so you'll have income taxes, but you also have a 20% mandatory withholding, and you have to pay a 10% penalty when you do your taxes. So the tax consequences are pretty dire when you draw money from your 401k plan early. So the distribution rule under CARES Act allows you to take up to $100,000 directly out of your plan, which is kind of a lovely thing. And the distribution will be treated as taxable income if you don't pay it back. So let me go through a couple of scenarios. You actually have the ability, if you draw that money out, let's say you take the full 100,000, you could, if you want to avoid taxes entirely, is pay it back over a 3-year period of time starting this year. That distribution can also get paid back over the next 3 years. And you can also do that in whole or part. And this is where your strategic thinking should come into play. So if you wanted to take all of it immediately, but just put some of it back in, you can do that. And the other thing that I think makes this the most interesting of all is the next sentence. You can put it all back in to the account that you took it out of, or you can put it back into another kind of retirement plan. So keep that thought in the back of your head, because we will be coming back to this point. So again, there's no 10% penalty. And the thing that's significant here is that there's no mandatory 20% withholding, which is a requirement for distributions from a retirement plan.
Can you explain that a little bit about the 20% mandatory withholding? I think everybody got that there's 10% penalty, hopefully, if you do early withdrawal, but the 20% mandatory withholding.
So the 20%, let's use the 100,000 as an example.
Mm-hmm.
Typically, if I was to draw 100,000 from my 401k plan, there's an automatic 20% withholding that's going to go towards your federal taxes. Now, you may get some of it back at the end of the year, or you may in fact owe more, depending on what your actual tax bracket is.
Mm.
So this is an initial withholding of which you might get some back, or you may need to pay more in, depending on what your situation is.
So the way that this kind of works, to just kind of break it down so my head kind of makes a lot more sense in my head, is because the 401k money is pre-tax. So when you contributed it, it's pre-tax. So when you take it out, that's why there's a withholding out of an estimated rate of 20%. So therefore, when you take out, and how is this withholding works? Is it that they just kind of somehow kind of like escrow, like they just put aside the 20% of the 100K, which is like 20K?
Yeah, no, it's going directly to the government.
Okay.
And it's just like a paycheck. When they withhold out of your W-2,
gotcha,
it's going directly to the IRS.
Huh.
So when you do your taxes at the end of the year, when you're calculating it all up, it's going to show that you've already paid into Uncle Sam $20,000.
Okay, gotcha. And then if you have a self-directed IRA, I'm guessing you as the policy holder, you're supposed to somehow give the government 20% right away at the moment of a withdrawal.
Yeah, so it depends on what kind of self-directed IRA you're using. So,
Mm-hmm.
for example, I have two different self-directed IRAs. One, I have everything going through that company. So
Mm-hmm.
they're doing all of the record keeping. They're sending in the documents.
Mm-hmm.
They're doing the fair market value. They're giving me an annual statement.
Right.
Now I have another company who I have a checkbook IRA with,
Mm-hmm.
and now they do quite a bit of stuff. When you take a distribution, you're typically not writing yourself a check.
Mm-hmm.
You're doing all of the day-to-day operations. But when it comes to distributions, they will also take care of that for you. You're not writing yourself a check, and you are not paying in the taxes. That
Mm-hmm.
administrator of the self-directed IRA, regardless of the type it is, will do that paperwork for you.
Mm-hmm. Gotcha.
So, for example, if I had $100,000 sitting in my checkbook IRA, I would actually need to send it back to the custodian. And I'm like, I want to take a withdrawal under
Mm-hmm.
COVID-19, and they will distribute that check to you. So there's a little bit of extra work when you're doing a checkbook IRA.
Gotcha. Okay. And then the similar apply to solo 401k. I think you have to kind of
Exactly.
do that mechanism like you, because now you're the policy holder. Like the solo 401k, you don't have a custodian. You're the custodian. So you have to make sure you administrate all this stuff correctly.
Well, in a
Yeah.
solo 401k plan, you still have an kind of like an administrator.
Mm-hmm.
You just cannot and do not want to write yourself a check out of that account.
Mm-hmm.
Because if you, in
Right.
fact, have included a loan provision in your solo 401k plan, administratively, that has to be done in a certain way. So you're going to want to contact whoever you're using as
Mm-hmm.
your custodian, because there is a custodian,
Yeah.
and ask them what their procedure is.
Gotcha.
Do not write a check to yourself.
Or the policy setter, essentially the person who helped you set up that solo 401k.
Mm-hmm.
That's usually the person you go back to. Because for me, it's like I'm writing check. I never write it to myself because that was one rule is that I make sure I follow. But sometimes when there's a questionable transaction, the 20% withholding is very interesting to me. I've never taken out a loan from my solo 401k, but this is definitely something I want to check with my policy setters on how exactly I want to administrate
You
that.
do, and if, for example, you don't have a loan on your plan, you're like, ooh, can I put a loan provision on my solo 401k plan? The answer is yes. You need to amend your plan. So there's a process that you need to go through to get that accomplished.
Gotcha. Cool.
Any other questions before I move on?
We did have a question, and I think this one we're gonna leave it later.
Okay.
Mark has asked about, how one can move the 100K from their W-2 401k and then change into a solo 401k. I think
I'm
we
going
have
to be talking about that.
Yes. So stay tuned on this. So we'll get on that.
His brain's thinking, I like it.
Yes.
So the bottom line is that you really don't have to pay any taxes for 3 years. I mean, you can pay it all back at the very end if you don't want to have any taxable consequence. Now, this does not apply to a Roth conversion. So if you're thinking, oh, this is a good time to do a Roth conversion, don't mix the two concepts. No, that's not going to work. It's really a separate thing that you want to be thinking about outside of this COVID-19 and how you can potentially be using this money. In essence, you get a 3-year loan tax-free. And the other thing is it offers you flexibility. It gives you some time to really think about whether you want to treat it as taxable or non-taxable. So you can give yourself some time to kind of think through or even change your mind in terms of how you want to handle these dollars. Maybe you pay it all back. So remember, you can also pay the tax off in 3 years. So they're letting you spread out your tax liability over a 3-year period of time. So those things can work in concert together. If you've had net operating losses that you've been holding, and you decide to keep the vast majority of it or some portion of it and not put it back in, you can use those net operating losses to reduce the impact of your taxes. But I want to remind you, it's really important that you understand that this CARES Act distribution provision ends at the end of this calendar year. So this is something you're going to want to be thinking about in the relative future, near future, in terms of if and you can use it and how you want to use it. The second provision that was impacted by the CARES Act is the 401k loan provision. So in today's world, if your plan allows for a loan, the loan provision works like this. You can take up to 50% of your balance or $50,000, whichever amount is less. So what this provision allows for is that number one is taking that $50,000 limit all the way up to 100, and they are eliminating the 50% requirement. That part is completely taken out. So anybody who has this much or more in their 401k plan has access to a $100,000 loan in their 401k plan. So again, you need to check with your administrator to see if you do have a loan provision. If you already have an existing loan, it does count against it. So let's say that I have a $25,000 outstanding loan. What that means is that I could take an additional $75,000 so that I've maxed out at that $100,000. So that's something for you to think about. In addition to that, the IRS is allowing that you can postpone any loan payments that you are supposed to be paying this year through the remainder of this year. So if I take a loan, I don't actually have to make any payments on that loan until January of 2021, which in essence gives you, at this point, for 5 years and 6 months or 7 months of time to repay that loan amount, where typically you have to pay it back within a 5-year period of time. I want to stop there and see if there's any questions or if there's
there was a question about, so can this example, so this actually goes to the previous slide about the distribution. So should, in this example, about 100K distribution be taken as either a loan or a real distribution to be taxed over a 3-year peririd? I think that was the question.
So you know what the answer is? You could do both. That's where the 200,000 that Elisa was alluding to in when she sent out the email. If you had 200,000 in your 401k plan, you could take a $100,000 withdrawal and a $100,000 loan.
So if I only have 100K,
then
which way would I go with? Like if I qualify, assuming if I qualify both, which way would you go with? The first one or the second one?
You know what the answer is? It depends on what your objective is. There's a lot of factors in determining what you should do. So, the question is, do you want to get the money back in there or not?
Right now, yeah.
And
the question is always right now, right? Because the retirement's in the future. So you have to keep in mind, if you take the money out of retirement fund, you don't have that in the future. So if that's a risk factor, should be considered. But hey, if you feel like you could be of a better management of it now, taking that out of there, then you may be choosing the first scenario versus the second one where you're still paying it back, but it's a temporarily like a 5-year, 6-year period of time.
So there's 2 things going on. When you take a 401k plan loan, there is no taxable consequence. That's the real big difference of taking money out of the loan option. So really it's 2 things. You have to pay it back, and there is no tax distribution. That's a non-issue, the tax distribution. It's not like taking a withdrawal where that 10% penalty may apply in the future if you don't get it back. Mm-hmm. If you just want to take the money out and use it and not have to worry about getting it back in because of cash flow, because this is the thing I would ask you to consider. What is your cash flow situation? Do you have the cash flow to make the loan payment back? Or do you want to provide yourself, you know, because in one situation you're paying it back over 5 years, and in the distribution, if you're wanting to get it back in, you only have 3 years in which to get it done. So there are several levers here that help determine what the better option is. I'd have to probably talk to the person who has the question in a little more detail, do a little more analysis to see what your situation is.
Yeah, that was a generic question that
The answer is it depends. It depends.
Right.
Sorry,
Follow
but
up.
that's true.
Gotcha. But answer to the first question was that, yeah, you can actually do both. It's not subject to that. Obviously, it's subject to your dollar amount that's in your retirement plan. But you can potentially do both. And then it's based on situational. You will prefer doing one versus the other.
Mm-hmm.
Great. Awesome.
So the next thing I want to talk about is taking the loan. There's a couple of factors I just want you to be aware of. First, you are paying yourself interest, and typically it's 1% over prime. Prime, the last I checked, was around 3.25%. So you would be loaning yourself money at like 4.25% as an example. Each plan sets up their own guidelines. I've seen, you know, prime +2. The vast majority of employers use prime +1. You have to look at the loan documents or the plan provisions to see what it is. So let's talk about this just in a little more detail. The one thing I want you to be careful of, and I think it's going to be here further in my presentation, is if you have had a large equity holding and we've just gone through this market correction, and while it has come back up, what I want you to at least be thinking about is you will be selling at a loss to use that money on the outside. So if you can take money from a particular place like cash equivalents or money markets first, or your bond portfolio, that might be a better place, because that 4.25% is actually a pretty nice rate. But I just wanted to point out to you that you are paying yourself back an interest rate based on the amount of money that you take out. The loan payment suspension, I already talked about that. There is no restriction on how you use the money. Nobody's going to pay attention or look at how you are using the money. So that's kind of a sweet thing. But again, there is a time restriction here. They allowed for 180 days for this loan option to sit out there on top of a 401k plan provision. And basically it's going to end approximately, unless they extend it, which is it's possible, but I wouldn't count on it. You would need to take your loan before September 23rd it is. That's about approximately 180 days from the day that the legislation was passed. So there isn't a limited time here for that loan option to be available. One other cautionary note, if you think your happy bud is going to leave your employer, let's say that you take a loan and it's a 5-year payment and you're like, there's no way I'm staying at this employer for 5 years. Or you decide to take a loan and then they let you go. It is possible that you will end up paying that 10% penalty. It will still be at the end of the 10 years. There's no way to do that repayment. This is part of the IRS guidance where we don't have very much guidance. What happens to someone who takes a loan, they get furloughed or they get laid off? What are they going to do for those loan payments? And that's something that's still out there. So that is an area of unease, let's say. And that's why I'm giving you this bit of a cautionary flag. And in fact, it might be another reason you decide to take a withdrawal versus a loan. So I'm really trying to give you all of the things, and I know it's a lot for you to consider, but I want you to go in with your eyes wide open. I don't want anything to surprise you. So just wanted you to be aware of that. Now there is this whole concept, if I take a loan, I'm going to be double taxed. And Lisa and I were talking about this yesterday. In one sense, that is true. You know, you put that money in pre-tax, and the only way that you can pay it back is with after-tax dollars. And then when you retire, you're going to pay taxes on it again. But there is something I want to just point out. No matter where you go to get a loan, you're going to be paying it back with after-tax dollars. You just never get away from that. So I've included these 2 articles for you to read through and make up your own mind. The first one is really about how that's not really true. If you look at the numbers, it's not really true. And the second one gives you a lot of things to think about, but it also it doesn't poo-poo, if you will, taking loans. I personally, you know, while I know a lot of employers don't always like the idea of their employees taking loans, I think it's nice for them to have that ability to have access to those dollars. And that's why I see this as potentially an opportunity for some people to take advantage of these easing of rules, if in fact getting at this money will give you some help along the way. Do I have any questions before I go on to burden of proof, which just kind of came up at the very beginning?
Not right now. I think there is a question on administration, which is, would the post link be posted? Yes, you'll be receiving an email from me with the links for the presentation, and also the links to the recording as well, as a follow-up to this meeting. I did have one question about, well, I just want to add a little bit to the above thing. You know, I think we're kind of taking this topic as with a lens, because not everybody has solo 401k or etc. But obviously the caution on that here, you know, likely wouldn't apply if you have a solo 401k. That's if your business goes out bankruptcy or whatever, then that still applies over here. But in general, you know, like us real estate investors, we create a solo 401k. In these cases, it's probably going to be more sustainable. So that may be a caveat around that caution. But if you have a traditional 401k, then yes, these should be kind of applied there. And it's interesting on the taxation thing, just kind of want to reiterate, make sure everybody kind of got it. It was like, hey, when you put the money in a 401k, it's tax free. But when you have to pay back the loan, let's say you take out the money back, and then you have to pay back that loan, the money, what Naomi is talking about, the money that you use to pay back the loan is a salary that you got, let's say, or something else that you have got as an income, which you pay tax on, and then you pay it back. Now, the double taxation happens when you eventually take the money out of the pot, because it's considered pre-tax money in the 401k. At that point, you pay another tax. So that's what we're talking about, the double taxation. But to your point, if I was to take a loan out, you know, over prime 4%, I invest in the real estate market, or I invest in, let's say, stock or whatever. And let's just say I invest in Delta Airline or whatever. Don't take this as advice, but let's say I did that and I made 3 times the money, you know, in a year, and then I pay back the loan. Would I take that? Yes, because I made like what, like 50, 100%. Right? And then I'm only paying at a cost of a 4%. So that's something to kind of keep in mind. And also, I just did a quick calculation. If you take out 200K total, like we said before, if you qualify, you're paying back essentially about $666.66 at the rate of 4%. Interest only during that time. So you need to want to make sure you can make that cash flow. And also you have to pay it back. Remember, the lump sum due at the end, I found it's usually harder to manage versus, you know, the interest part of the thing. So something to kind of keep in mind on all that sort of stuff. Yeah.
Awesome. So who has the burden of proof? Well, ultimately, like I said at the very beginning, each of us has to carry that burden of proof. So I'm just saying to make sure that you are not getting outside of the bounds, like saying, oh, I'm affected, and there really was absolutely nothing affected in your household. I would advise against it. I don't know that it would be worth it, truly and truly. But if there have been impacts and you are interested, make sure you have a few things that you can put in your file that say, hey, these were my impacts. I mean, and then I think it's highly unlikely you're going to get audited, but I would never sit here and say, oh, you don't need to worry about being audited. I just won't do that. Ultimately, your first step is to go to your plan administrator. They may or may not. It's really up to the plan participants to provide that proof if in fact they're asking for it. So my experience with the plan sponsors that I'm working for, they are not asking for most. I don't know of any yet who are asking for actual paperwork. You know, they're taking people at their word. But you do want to check with your administrators, see if they have any things that they're asking for, or, you know, in terms of providing some evidence.
Yeah, and then and again, in caution of the solo 401k holder, I'm always in the camp of you always want to be more secure, just in case in the odd days where IRS start auditing you, right? Especially with us who has more complicated tax scheme, not tax scheme, but like tax strategies around depreciation, etc. Our risk of getting audited is probably slightly higher than the regular people. So you definitely want to keep that paper trail with you, especially because you're kind of mostly large in responsibility of monitoring the policies are properly executed over there. Yeah.
So the next thing is that, retirement plans are not required to adopt the CARES Act. And so for the company that I work for, we've seen about 10 to 15% of employers elect not to adopt it. And in fact, sidebar, solo 401k people, you are also going to have to adopt these provisions, and I would have you talk to your administrator about it. So you have to decide whether you are going to or not allow for this CARES Act provision to be synergized into your retirement plan. So again, you need to check with your plan administrator.
Oh, so that's interesting. That means among all these paperworks that I receive as a solo 401k holder, account administrator, basically I probably need to go back to my administrator to get that one piece of extra document to say, hey, we amend this, and then it's now including the CARES Act, the provision in that particular language.
Yeah, in fact, what's kind of interesting is that you can adopt it, but you don't need to do the amendment paperwork until sometime down the road, and I don't remember what those dates are. I can look that up if anybody needs it, but your administrator is going to know what those dates are. So you can say, yep, I'm going to do it. There'll be a checklist typically of things that you need to do, and then they're going to give you a time frame in which the amendment document has to be done. So it's kind of interesting. They're letting you employ the strategy now, and then allowing you time to actually amend your plan later to include those provisions. A couple of things, so you can see that my brain thinks about the opportunities here, but I also have this part of my brain where I don't want people just to go run out and do stuff that's going to be harmful to them. So I just want to make sure I'm coming at this, that there are some really fabulous concepts in here that can be, I'm going to say, taken advantage of. And there's some things that you want to be thoughtful about. So the very first thing is that you have access to cash that you have not had access to before. Maybe you had access to your 401k plan at $50,000, but this is at a whole new level. $100,000 distribution, up to $100,000 loan option. That's a lot of money that can do some stuff that you have maybe been thinking about doing. But the biggest thing that really strikes me is the redeployment of assets. So I'm going to stop here and just mention this. When I think about redeployment, here's what I think of. Remember towards the beginning of the presentation, I said that if you withdraw money, you can put it back where you got it, or you can put it somewhere else in another IRA. So my brain's going ding, ding, ding. I could, because now there's sidebar. Some 401k plans have what they call an in-service withdrawal provision, which means if you're 59 and a half or older and you're still working, you can withdraw money from your 401k plan and go do something with it. You can roll it over, whatever. But if you're not 59 and a half, all of a sudden you have this potential amount of money that here's how I think about it, that I could take out of my 401k plan, and then I can use it or whatever, or I can just simply move it right over into my self-directed IRA. I could put it over into my self-directed 401k, my solo 401k, sorry, is that too. And so I've taken the money from here and I put it over here, and now I have no tax consequence. And now I have the ability to be a little more creative with what I'm investing in, for all of those of you who are like me and like investing in real estate. This is where I see the opportunity. All I did was reposition out of here and I put it over there, no tax consequence. And now I have the ability to invest differently than what I have in terms of my investment platform inside of my 401k plan.
So wait, Naomi, let me kind of get this example. So this kind of pertains to people who still have a W-2 or
This
has
does.
been with their employee for a very long time and don't foresee them quitting their job with the particular employer, right? So in the past, I've kind of advised people on my lay, look, if you want to get a 401k, this is kind of outside the box thinking. You may want to quit your job and come back later, right? So it's a little extreme measure, I know. But in this case, are you saying basically, I can take the money out from my current W-2 employee, because in order to get the solo 401k, get that transferred, you need it, not like usually most employees, pretty much 99% employees, not going to let you do that to essentially move this into a solo 401k while you're employed with them. So only after you like left that job, then you can move it into a solo 401k. That's kind of how I did my thing. So you saying we can use this provision to take the money out from my traditional 401k, who I have with my current employer, and then move it into a solo 401k. Let's say I have a side business that's already open, got founded, with that solo 401k, so I can potentially do that. I think that was one of the questions.
That's what I think of when I think about this. I'm like, if I wanted to, and that's why I call it a redeployment of assets. So, it's not like I don't like my investment options, but I really do like and feel comfortable with investing in real estate. Mm-hmm. Now, cautionary note again, I'm like, do you want to be overweighted? These are some things for you to think about. But yes, whether I wanted to put it into my self-directed IRA, as long as those are qualified dollars, do not commingle. Do not, that's 3 nots. It's still a negative. Commingle qualified assets that are all pre-tax with some after-tax IRA dollars. You do not do that. That's a huge tax.
Like Roth IRA. Like you can't just move the 401k, for example, just to put into a concrete example, is that, hey, taking the money from the 401k account and then, okay, I'm going to put the money back into a Roth IRA that I already have. That does not work. But you can move your money from the 401k account. Let's just say you don't have a solo 401k, but somehow you set up a self-directed IRA. You could move that into a self-directed IRA, which is a traditional IRA vehicle. And that's also, pre-tax vehicle. So these are okay. Yeah.
Yes. Cool. So you can see where I'm going. This is where my thinking cap comes on. Like on the one hand, that's one thing I could do. On the other hand, I could take it out, use it for 3 years and, make sure I get my money back to put it back in. And I need to have a backup plan if that doesn't happen and know that I'm going to have a tax consequence of $100,000. So I hope I have enough net operating losses that I can minimize my tax burden at the end of that 3 years. So those are the pros. The cons are, if again, you have been in a highly equity oriented strategy with your investments and they've seen a 15 to 20% decline and now you're going to pull that money out, I want you to be aware that you are locking in your losses. And, so that's something I want you to be really thoughtful about. Do you want to do that? So that can have a negative impact. You've lost the time to try to gain some of those losses back over time. And I do want to say, repayment can be complicated. If you start, I think I'm going to pay it back, and then you don't, it's all of this stuff isn't really all ferreted out, but it could be a bit complex. Like, let's say, for example, you're starting to pay your taxes back right away, and then you decide, I'm just going to take it all as a taxable event. You have to kind of true that up. There's going to be forms where you have to go back to and re-amend your plan. Some of those things could happen. Questions?
Yeah, so we have a question over here about, hey, is there documentation that needs to be provided to original plan provided W-2 employer if moving the fund to the solo 401k? My understanding is you're just simply taking the provision, like you have to follow any qualification to show your hardships and etc., just to take the money out. And then where you put it, like now, I guess the question goes like, hey, once you put in solo 401k, I'm guessing there's some evidence that you got to show your administrator, your W-2.
Well, remember, it's probably going to go directly to your administrator, or you're going to need to involve them because there are tax forms even when you just roll money from a 401k to an IRA, there is a distribution form that comes out at the end of the year, and then there's another form that you get both of them that shows that money went in, so they can see that it went from point A to B, and that's what you have to be prepared to be able to provide to the IRS. It's not so much to your employer, it's to the IRS.
And then, so that's where you combo it. Now for all of us, like for all, I don't use them, but like for all you guys still use, what was it? The tax software. Oh my God, I just went blank on that. TurboTax. This may be something that may not cover. I don't really know. Hopefully TurboTax has updated their software for it. But I traditionally work with a CPA. And this is where it becomes very important that he makes sure my T's are crossed and my dots are dot. I think that's how I say it. So that's kind of where, going back to Naomi's first saying, is like any investment strategy, you should have a team with you, and making sure you kind of cross this. I run everything by my CPA, and this is definitely one of the things that I want to make sure that the documentation, etc., is there, so I don't get, whipped at the end. Yeah.
The last topic, I'm gonna fly through this so that we have more time for Q&A. I just want to make sure, I don't know what the age of everyone is, obviously, that's listening to this live or in the future, that might be over 70 and a half. There was another piece of legislation that passed in December of 2019. And the bottom line is that there's something called a required minimum distribution. It's RMD. And the IRS is like, listen, people, we've let you reduce your taxable income and blah, 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 but we want to make sure we're getting our tax dollars back. So we're going to make sure that you take at least a certain minimum amount from your account starting at a certain time. And if you don't do that, we're going to penalize you 50% of what you did not take. It's an extreme tax situation. So RMDs cannot be taken lightly. The only thing I really want you to be aware of is that the age went from 70 and a half up to age 72. And what CARES Act has done is to say, like, listen, if you have not taken your RMD this year in 2020, or if you were supposed to take it last year and you were waiting to take it April of this year, you can postpone it until 2021. So again, this means that you can potentially keep money invested, whether it's in real estate or something else, for another year before you need to tap into it. So if you've already taken it and you've done it, you still have 60 days. You have 60 days from the day of taking it out to get it back in. So I just thought that would be one other quick tidbit that I would leave with this group in terms of investing. I wanted I'm not going to go into these, but you can see what the name of them is. I just thought this was the most interesting, that's the word I'm going to use, article where it talks about taking money out of your 401k plan, like taking a distribution and paying off your mortgage. So there's some math behind it, very interesting concept, but the same could be applied to your real estate. So take a read if you're interested in it. And then this is just another, I think, a pretty neutral article about whether you should use your retirement assets with this CARES Act. So I thought I would just give you a couple of other sources. Where I want to really get to here before we get to questions and answers is, hey, do you have a W-2 job, or do you have a solo 401k plan? Do you work for the government sector, the teacher sector, the hospital sector, and do they offer a loan? Yes or no? And that kind of is your tree. If they allow for a loan, then you have the option of either a loan or the withdrawal, the distribution, or both. If they don't have a loan provision, you still have the withdrawal provision available. You're going to want to go to your administrator, ask them if they're allowing for CARES Act provision in your retirement plan, and that's where you're going to get all of your paperwork and the necessary information for you to move forward. If there's something specific to your situation you want me to try just to weigh in, you can use this email address, nhgconsulting@gmail.com. Give me your phone number and times. I will try to schedule you into my calendar, and we can at least chat on the phone. I'll help you to the best extent that I can. I'm not charging anything for it, but I also don't have the time to give you like an hour of my life. I mean, so if it's, a 10, 15, 30-minute chat, no problem. I will help you the very best that I can. I'm an educator first and foremost. So if there's some value or help that I can bring to you or get you in the right direction, I'm happy to do that for you. And at this point, it is additional questions.
Yeah, so I did have a couple of things I want to cover. It looks like we probably wouldn't have time to do it here. But it's not quite related with CARES Act, because I want to just do a quick launch of poll over here. This is my first time doing this over here. So participant, if you can kind of vote this and give us a good idea on whether or not we should be like covering these costs topics over here. So I'm going to launch my poll over here. And you should see a pop-up on your box, and then just go ahead and do some over here. While folks are doing that, we did have a question on this. It's probably mostly to me. There's a person who's asked about, hey, did any syndicators has projects that cater to this provision? We don't have projects specifically for tax purposes. All our projects needs to make sure that the math actually makes sense, right? And it should be a sound fundamental without the tax benefits and etc. Because at the end of the day, you know, some people can take tax advantages, some cannot. But that being said, this is very eye-opening even for me. Like, I'm like, wow, my wheel thinking, like the fact that I can actually turn some of my, I'm actually gonna go text all my investors now, because a lot of them are still W-2 job, you know, and then they been kind of racking their head on like, hey, how do I move this to my solo 401k, right? And then they just sound very defeated when they couldn't quite do that. But this could potentially be a vehicle for them to kind of start doing that move. So we did have the pool that comes in. Looks like most of us have a, you know, some folks has a 401k, solo 401k. Majority have a traditional IRA and the 401k plan. So that's a very good cater on this with Roth IRA. So actually, I think as part of this topic, I would love to kind of have maybe Naomi's to come back and you know, maybe do another session on the solo 401k and the self-directed IRA. Now, just on a very high note, I know some of you guys invest in syndication, whatnot, or use your money to invest your own projects, this and that. There's always, if you are going to invest in a vehicle that has an equity portion at the end, where you're having a gain, you know, from the sale eventually, there's a specific tax related with a UBIT or UDFI tax with taxed with IRA accounts, any IRA accounts, Roth IRA, traditional IRA accounts. Now, this is why I always recommend a solo 401k plan instead of a traditional self-directed IRA or self-directed Roth IRA to invest in, to avoid that particular UBIT tax. But all is not lost. As long as you convert that into a solo 401k plan, you know, until you exit, like that's potentially can be write-off, right? So that's another topic by itself. We wanted to get into a little bit more, but it looks like we're kind of running out of time on that. Just by show of hands over here, you can put it in the chat. How many people are interested in that particular topics on deep dive? That's if Naomi has more time to kind of come back.
Yeah, I think so. I mean, yeah, of course I would. I love this stuff. And I would just say, you know, if you're someone who's considering one of these strategies and you don't have a self-directed IRA, you can set one up and fund it later. If you're someone that's interested in doing a solo 401k plan, there's you know, Elise and I talked about this, and this is probably a deeper dive, but there are ways that you can create some 1099 income that then allows you to start a solo 401k plan, and it might be worth your time. So yeah, we can definitely cover these topics in more detail, but yeah.
Yeah, so kind of on the high level over here is kind of more a segue, not to take away from the topic was talking here, but looks like everybody's asking that. So if the difference over self-directed IRA, not only is that UBIT tax traditionally I found because of all the custodian jobs that you need to have a custodian administrating that. So there's actually, they nick and dime you, honestly. You actually pay a pretty high fee with a few reputable custodians that's out there. So that's another thing. If you have a solo 401k, I have my self-checking writing ability. I don't have to pay that fee, right? So that's the difference between the two. And of course, that UBIT tax is pretty big indication. And to Naomi's point, there is some qualification rules around it, which means that you have to have a 1099. Like Naomi is saying, you can be an independent contract, like deliver grocery for Instacart, right? Something like that could qualify, or drive Uber for all I care. Or traditionally, a lot of our investors turn their hobby into an LLC, turn the hobby into a income generating activity, right? So that itself can qualify. You don't have to necessarily profit, but you need to have that activity that justify for it, and then you can open a solo 401k. If you really don't have time to do that extra side work and etc., then self-directed IRA, it still makes sense for you. Don't be afraid to not changing into that and start investing. Because again, traditionally, like our syndication project or real estate projects, it may take 2 to 5 years for you to realize that. And in between that time, some people find some hobbies and some people find some time start doing 1099, and then they will invest in self-directed IRA and then later on convert this into a solo 401k. So as long as you kind of convert it before you exit, again, I'm not a legal person on this, check with your CPA, etc. Usually from our side of the folks who's doing syndication, we noticed there didn't seems to be a lot of differences over there, because over the year we give you a negative K1 anyways, right, throughout the investment cycle. So that to answer someone's question, do you recommend a solo 401k or a self-directed IRA? Yes, I have a solo 401k. I like using it to invest into other vehicles. It expanded my horizons a lot more than what the company has regulated on the 401ks you can invest in. For example, I invested in note funds, like notes essentially, or I invested in other people's syndication projects. You can even, if you can get a non-recourse loan, you can even basically invest in your own projects as long as you can show reasonable proof that it's an arm's length transaction. You don't do anything active to it, right?
Lisa, the one thing in relation to the CARES Act, I mean, if you have a tight time frame and you're considering a solo 401k plan, maybe the better option is just to get started with the self-directed IRA. That won't take you as much time if you don't have 1099. And if you're looking to redeploy assets into a self-directed IRA, which ultimately you could at a later time roll that over into a solo 401k plan. So that is a path for you to get where you want to be. Maybe you can't get exactly where you need to be initially. So the self-directed IRA is at least a starting point if in fact all of this kind of aligns for you.
Cool, that's awesome. Yeah, so I have a lot of other questions. There's a couple other strategies, just kind of like make your guys' brain explore it a little bit more. So we'll have Naomi come back and maybe cover some more of these questions, such as, if you're a real estate professional, and maybe it'll be a great panel between you and my CPA, who's going to be on next week, kind of talk about this topic, because then you get an aspect of a taxation as well. So one of these questions I had was like, hey, I'm a real estate professional. Could I then, because I received these negative K1 from my investments, from my real estate investments, could I then, and I use 401k, solo 401k to invest in them, could I then take out the money, and sure, I have to pay that 10% penalty, but it will offset all the gain that I made, which is really the big chunk of money. Like the 10% is not really a big deal, but the capital gain is the big chunk.
The whole point is if you do take the withdrawal, and so I think what you're saying is if I take the withdrawal and I know that I have some healthy NOLs sitting over on the sideline, I'm going to be able to, I have $75,000 worth of losses sitting over here, and I can apply it to the 100,000. Then that means, so that would be that's a math equation, and I would say, I'd probably consider that.
Yeah, definitely.
If the situation's right.
Right. So there's all these kind of tricks with like these topics can kind of go on and on. So I think we'll probably wrap it up today's conversation. I'm just kind of looking at some other questions around this particular topic. Can I roll over a Roth IRA to Roth solo 401k? That's very interesting. A Roth solo 401k, I don't see it very often. In fact, in all my years doing syndication, I've never seen one. So what is that exactly?
So, 401k plans can have both a traditional and a Roth option. So a couple of things I want you to understand. Employer contributions must go in as a traditional contribution. That's the only choice in employer contribution. So whether you're solo 401k plan, you have a match program, it's the employee contributions that can go in the Roth bucket. So inside of a solo 401k plan, you're going to have to decide in your plan design, do I want a Roth feature? So it's not like you have a Roth 401k plan. What you have is a Roth feature where you can put your contributions into that Roth option, and it works a lot like a Roth IRA. There's a few different rules that are different, but there's no such thing as a Roth IRA. It's just, do you have a solo 401k plan with a Roth feature?
Gotcha. And then, so why don't I see it very often? Do you know, like, there must be some sort of disadvantage or something with it? Traditionally, I only see a solo 401k, and the Roth IRA is pretty common. And you know, a
Well,
self-directed
this is all
IRA.
about people's their tax situation. You know, obviously, if I'm putting in it pre-tax, it's reducing my taxable income. If I'm putting the money into the Roth, there is no tax benefit immediately. Rather, what you're looking forward to is that those earnings compounding, and when I do get to retirement, being able to take them out tax-free. So you're making an election of what's more important. Right now, taxes, or later on down the road, taxes. And sometimes there are people that split their contributions. I'm one of those people. I have a certain amount of money going into a Roth 401k plan. I have the majority of my money going into my pre-tax, because right now I'm very interested in reducing my taxable income. But then I also have money going into a Roth IRA. So it's about taxes, where you are today versus where you think you'll be tomorrow, and what's more important.
Makes sense. Okay, so there's other strategies we'll have Naomi come back and talk to us about. Maybe I can have Thomas, my CPA, on it as well. Next week, we're going to be talking with Thomas, my CPA, to kind of really do a deep dive into CARES Act and all the changes that we had for the 2019 tax year. So for some of you guys who haven't filed taxes, that could be useful. And some of you guys are strategizing 2020 tax, that can be super useful. And again, there will be more of a Q&A session, but we're going to come back and cover some more topics about these retirement funds. I think we can talk days with this, right? So maybe our next topic on the retirement path will be, you know, different ways, efficient ways for you to convert. What is a backdoor, you know, Roth IRA conversion? How did that work? And all that sort of stuff to kind of efficiently strategize this. I don't want to blow everybody's brains up too much at this point. So yeah, so we'll cover them and hopefully with Naomi as well. And you know, keep on tuning in our talks. You will receive a link for the recording. So it wouldn't be public, but later on in 2 weeks of time, and they will become public. If you like our session, please share our presentations somewhere with your friends and refer to them. Send a link. You know, I'll send out the recording link. So send that link to your friends and etc. Get them interested on these. Great. Well, thank you so much, Naomi, for your time today.
I had fun. Thank you for having me.
Yeah, and thank you everybody for tuning in this because I know it's the middle of the day right now. And you know, thank you for tuning in and giving us your precious time. Hopefully this is useful. Great. Thank you.
Everyone, take care.
Bye.